Let's look at and reflect at events happening in Egypt and what happened in Libya, affecting companies beyond these countries, like Turkey and beyond. And this safety, my previous presenter spoke about the safety of the passage in the Gulf of Eden with the Somali pirates. And the investors who have put money into these ships and the commodities. They are concerned about the investments that they've put into the monies that they've put into the cargo of these ships and the effect on debt and equity. Let's look at the technological advancements that have occurred, the cloud computing, the risks in cybercrime. The technology has become so advanced. Most companies are using technology in advancement on enhancing their productivity and quickening the delivery of goods. And this comes with risks as well. Think about the floods, recent floods in Thailand, Mississippi, New York, Kenya. Think about the earthquakes, the shifting tremors, the shifting plates where the global earthquake maps is being shifted and changing. The previously areas which were moderately or low or moderate type of earthquake propensity are becoming high. Think about the volcano in Chile that disrupted the flights in Australia. Think about the volcano that happened in Iceland that disrupted the world economy in terms of people going for various meetings throughout the world. Think about the economic loss in terms of travel on the global supply chain caused by events happening somewhere where we wouldn't expect. Think about the ferry disasters in Congo, in Deriza, the mudslides in Brazil, the floods in South Africa. All these are concerns for investors. So let's look at risk and corporate strategy. Corporate governance has been mentioned many times. Corporate governance is key to risk management strategy. It has to be adopted from the board level with envisaging of operational and enterprise risk management, maximizing opportunity, identifying where threats are. Investors are interested in good corporate governance. They don't want to invest their monies in dubious characters. They don't want to put money where they know that this company will not adopt good corporate governance, such as good environmental standards, like Equator principles, which have been adopted by most banks throughout the world. Risk and corporate governance go hand in hand. Look at succession planning. Look at keyman insurance. What would happen to a family-owned companies if there are disputes where investors have put their monies? If there is shareholding dispute in the event of death of a key sponsor. Senior management and boards need to embrace risk management throughout so that the shop floor workers are well accustomed to risk because they will know that senior management has embraced risk. The backlash of the environmental disasters. Think about employment of child labor and how this might have a backlash to customers in Europe on goods that are being manufactured in Africa and elsewhere. Think about the bad environmental practices. Investors want to know whether the companies are capable of managing environmental disasters should they happen. What risk management principles and steps and procedures have been put in place to manage these risks before they put in their money. What might happen is that an investor might be named in a lawsuit together with the company in the event of a disaster, resulting in the reputation of the investor being marred, being affected, and also the company might lose customers, the customers might boycott because they did not follow proper environmental standards. Interestingly, in the 2012 Global Economic Report, which has just come out a couple of days ago, they talk about the risk about aging population, the risk of social instability throughout the world. These are the emerging risks that have to be on the radar for the next 10 years. And companies and sponsors need to be aware of this and the impact on the businesses so that they can attract capital. I'll walk you through some solutions that are being devised and by giving an example on a project, infrastructure project, BOT, which is Build, Own, and Transfer project. Let's look at the development phase. What risks are associated with this? Might have technology risks, credit risk, or the bidding risk. So what will the investor look at in terms of managing and mitigating this risk? For technology risk, the investor might say, okay, the sponsor must put in more equity or subordinated debt. On credit risk, they might request a letter of credit or ask a credit rating agency to rate this company. The bid risk, they might request a bid success fee, and all these cost money. So what can the projects come up in terms of solution? They might have to prove that they're going to use proven technology and they use reputable supplier. They might provide guarantees and security of property or land or government guarantees or bank guarantees. Or they have to prove that they've had previous experience and therefore they're going to use reputable contractors and suppliers. And let's look at the construction phase. You have the risk of cost overruns on the project, or force majeure events that might happen, natural catastrophes. You might have political risks and completion delays. So what are the solutions? From the lender's perspective, they will say, okay, we'll have a fixed price contract. We'll need a completion bond, standby credit, or they might request for increased equity to avoid cost overruns. For force majeure, they might say, okay, let's have a government guarantee because insurance is not going to pay for everything. Or they would say, okay, we need export credit insurance cover. Or let's have restructure this project so that the government is a joint venture to minimize political risk. All this, I'm trying to get to the fact that insurance is not the ultimate solution for mitigating and managing risks. Insurance plays a part, yes, but their role is not holistic. On completion delays, the investor might say, okay, we need a tanking contract. We want the contractor to pass on the keys to the project after completion so that the risk transfers to the contractor. Or they might say, okay, we introduce penalties and completion guarantees into the contract. They might introduce performance incentives so that the contractor completes quickly so that they can get a bonus. And might request certain types of guarantees as well in addition. So the project might say, okay, the lender has come up with this, how are we going to resolve it? We're going to devise a project risk management, employ a project, well-reputable and qualified project manager for the project. We're going to have strict budgeting, well-proven, have a technical advisor on the project, and have a performance bond for the contractor, and take out some insurance. All this is negotiated to make sure that the project attracts finance. Otherwise, the lenders will not be able to agree. So some of the solutions during operations, for your own information, the risk is higher, much higher in the development and construction stage than in the implementation stage. However, the completion risk becomes higher on the other end when the project is about to be completed, because the project might not deliver as intended. There might be technical performance issues. There might be operational maintenance issues. There could be the liability risk associated with this project. Lenders are very careful. If they are associated with the project, they can be sued together with the project if, say, they are contaminated goods that are sold to overseas. Lenders can be mentioned. Smart lawyers would name everybody in the supply chain. So lenders would want to make sure that there is liability insurance. There could be financial risks like foreign currency, which could be part of the political risk. So the government might decide no more remittance of foreign currency. Or there could be fluctuations in interest rates impacting on capital or working capital on the project. How is all this managed? Is there any hedging? Are there any derivatives that can be devised to manage these risks? There could be market risks. Market risks have to do with sellability of the goods, redundancy. A completed project could be very successful, producing nice goods, but there won't be any market to buy because trends have changed. The products become obsolete. The sponsor or the project has not done its homework in terms of doing a marketing survey and continuously assessing the opportunities, the threats, the competition within the market. So lenders are very much concerned about all this. How is the project and the sponsors, how are they managing these risks? Supply chain risk could be a problem. They could be using spares or raw materials from one source or one customer. What happens if that customer is no more or shuts down? It's a small customer and it runs into debt. Does the project have control over that supplier? What if products are being, rather raw materials is being manufactured in a hostile country? All these risks have to be assessed by the project, and also they have to prove that these risks have been managed so that the lender can provide finance. Let's look at other risk considerations which the lenders look at so that the project can manage them and attract capital. They have to determine the risk management appetite. The project should not take a lot of debt which it cannot manage. For example, self-insurance and retaining risk that otherwise should be being passed on to third parties. The lender is interested in knowing whether the company or the project will be able to recover if anything happens. For example, if there is a disaster, are they prepared to get back on their feet? How long will it take them to recover? This is done by using scenarios, scenario planning, scenario analysis, and introducing shock into these processes to determine the resilience of the company in the event of disaster. And business continuity. How long would it take them to get back to their feet? How long would it take them to full production? And during this time, would they be able to service the debt? Would they be able to meet their obligations? How resilient is the company? Are they able to communicate with the external stakeholders properly, adequately, in the event of a crisis? For example, if there's an accident at the production plant killing people and there was negligence, there are various stakeholders who are interested. There could be community organizations, there could be families, there could be customers. One nice example that I was reading when I was on the plane is Apple in China. They've just done an inspection on about 4 plants, and they've realized that there are high suicide rates, and the community is outraged. And they have to devise a community action plan to help to manage these risks.